Okay, while the last few folks are funneling in, let me say congratulations to you all. You figured out how to find your way to this room. It's the end of day 2, and you're here at the last session today, and the only thing between this and the reception is what you're going to hear. I'm Nick Desport with American Company, and it's a pleasure and an honor to be able to moderate this session. I've got a couple housekeeping notes to pass on. Again, if you're here for a session, it should match this. This is what you're here for: ownership changes and succession planning, big deals. So you've heard this all before, but I just want to restate exits front and back if you need to in case of emergency. And every session I've been in, although they've said silence your mobile phone, someone's has gone off. So please check for me, make sure you've got it silenced.
Or turn it off.
Or turn it off, yeah. And just want to say thank you to all our sponsors. They're all listed on the back of the program. This has been an amazing event thus far, and again, it can't happen without the sponsors. You will receive 1 PDH for attending this. You should have been scanned along the way. If by chance you did miss that, you can self-report, and there's not a problem with that. Also, the presentations for this will be available on the SAME website next week, and the session is being audio recorded. So I just wanted to make sure you had some of that housekeeping notes. If you do choose to ask a question, we'd like to know your name and who you work with. So right now, I'd like to introduce our speaker. Her name is Michelle Cantor, and she leads the Federal Government Contracting and Procurement Practice Group of McDonald Hopkins LLC law firm. She's been doing that for more than 30 years. She also serves as general counsel to the Federation of Women Contractors and is on the Chicago Women's Business Development Center Advisory Committee. She's also been recently published in Crain's Business as Most Influential Women Lawyers in Chicago. For those of you who may not know, I used to work at SAME for about 5.5 years, and so helping set up the program, I got an insight into how speakers were chosen, how we chose them. And I know that Michelle has been chosen numerous times. I listened to the review committees, and because of feedback and what the reviewers have thought, she's always been one that's top on the list to be speaking. So I was, of course, impressed again to see that you got chosen.
Thank you.
And so I think for those of you who are here, I think you're going to really enjoy this. So without further ado, I'd like to introduce Michelle.
Thank you very much. So I'm your entertainment for the next hour, and I want to just first tell you that if you don't mind, in terms of videos, it's being recorded anyway, and the slides are up on the website. If you not take pictures, and I get very distracted then, and I'm having a little bit of a time with my eyes, so to bear with me and tell you that. That's the housekeeping. How many of you are large businesses in the room? And then service disabled veterans businesses, veteran businesses, 8As, hub zones, small business, woman-owned. There you go. So all you large businesses, when you saw the hands of the small businesses, that's who you should be teaming with afterward, after this session. And how many of you are looking to acquire a business in the future? I know there are some people here that are looking at acquiring businesses. And then how many of you are looking to potentially sell a portion of your business? Okay, and or the whole thing, the whole kit and caboodle, retirement, right? Good. So hopefully there's a lot of information in here. I'm going to try to zip through it, but I'm going to be here afterwards. I'll stick around as long as you want if you have any questions, or if you have questions during the presentation. If there's a lot of questions, we might stop it and wait till the end. So I like to start my presentation because it's a little bit of a classroom, it's a learning session, so I like to start with a quick funny video. And hopefully it will work.
Time, thank you. Could you all please put down your pens and bring your papers to the front of the room? Well done. Thank you. Oh, I'm sorry, you're too late. Gave you plenty of warnings about time. You failed. Sorry.
Excuse me, do you know who I am?
I had absolutely no idea.
Good.
So today we're going to talk about types of ownership changes out there, because there are actually numerous types of ownership changes, and then changes that could compromise small business certifications. I don't know how many times people come to me and they say, Michelle, I just bought a company and I'm a woman-owned company. My corporate person told me, my corporate lawyer told me I'm a woman-owned company, but I can't get certified. They denied me. And then I started asking the questions and say, yes, that's why you were denied. So you don't want to acquire a company, think if you're a small business and you're looking to acquire, let's say, a woman-owned business, and thinking that you're going to be a woman-owned business, you don't want to spend all that money knowing, not knowing that whether you can actually have continued continuity in your certifications. And then sometimes just a new ownership interest in your company can actually destroy a veteran certification or an 8A certification or even a small business certification, depending on who the new owners are and if they have affiliated companies or not, which we'll talk about. We'll talk a little bit about structuring, how people structure transactions, due diligence with ongoing federal contracts, because it's not just, oh, I'm going to buy a company and it's, the Department of Defense is going to say, sure, you could take on this new contract, right? And then a little bit about financing the transaction, which is what everybody really cares about, is like, how do I sell my company when I have a potential buyer, but they got no money? So we'll talk a little bit about that. But so in the presentation today, I want to talk about, just to keep this in mind, what actions that compromise various small business designations. A lot of times I say certifications. The SBA certifies 8As and hub zones. There's a self-certification process by the SBA for veteran and service-disabled veterans, but as you know, the VA actually certifies veterans. So I mean certification in that way. And some of you, and if you might raise your hands, how many of you also do state and federal work where you're MBE, DBE, or WBE certified? Well, that's really important, because the federal rules, state and local agencies they differ as it relates to eligibility and control of a company. So even though you think you're doing okay with making some type of structure change in your organization, it might potentially destroy your DBE certification. So it's really important that you keep other certifications in mind when you're making these changes. Affiliation is a big deal, and so all of you know what affiliation is. If you've heard that, the bad term. It's not such a bad term in the normal world, but in small business contracting, it's a bad term. Because what happens in a small business contracting, if there's an affiliation with another company, they'll add the gross receipts together with that. If you have an affiliation with another company, they'll add the gross receipts together of that company, and you could potentially be no longer eligible for an award of that contract. And also, affiliation can destroy your ability to even get certified as an 8A or get certified as a service-disabled veteran. There's numerous types of certifications. If you have some questions on it or want me to talk more about it at the very end, we have time, I'd be happy to. But just know that for me as a lawyer, helping people buy and sell small businesses, that's one of the first things I think about is affiliation. Because you think you're buying a small business, and the next thing you know, or you're buying into a small business, and the next thing you know, that certification could be destroyed. And then failing to give proper notice, and then not only exceeding size caps with affiliation, but also personal net worth caps. So all of you who are 8A have a personal net worth cap and an adjusted gross income cap. And those of you who are EDWSB also have to be under that personal net worth cap. And certainly if you're DBE, you have to be under that personal net worth cap. And so an example of how you can destroy without wanting to your personal net worth cap, for instance in DBE, is let's say you want to acquire another small business and you're an S Corp, right? So your small business, you acquire another small business and you make that small business even a subsidiary. Well, in S Corp, your adjusted gross income is on your tax return and it flows through. The profits from your company flow through to you personally. And by just acquiring another company, you could exceed your adjusted gross income cap and lose your DBE status. So so I'm going to give you tips, and kind of some of you like I'm looking at going like this because you're DBE, but hopefully there's a little bit for everybody here in the various types of companies you're at. Everyone can hear me, right? That's normally not the problem. All right, so ownership changes scenarios. Partial or complete ownership changes occur under a variety of scenarios. It might be succession planning or estate planning and retirement. Succession planning isn't necessarily estate planning, right? Succession planning means that I want my company to survive after I leave it. I've been, for instance, the sole owner, 100% owner, but I want that company to stay alive. So I want to sell the company to my brother. I want to sell the company to my employees. I want to make it an employee-owned company called an ESOP. That is the succession of when you're departing, all right? And then some of you make ownership changes because you just need money. You want infusion of capital into your firm. People also, there might be a person that you really want on your team. They've got the relationships, they've got the expertise. You want to get into a different line of business, not a different, but a separate line, or you want to offer additional services, and this is the key person, and maybe they don't want to come on unless you offer them a portion of your company. And that happens frequently. Key relationships that another investor can bring to the table. And then retaining employees is another reason I hear a lot, like, listen, Michelle, I have to give my employees some stock ownership, otherwise I'm going to lose them. You know, what can I do, and how do I not compromise that certification by giving my employees stock ownership? Because it can compromise your certification. Why do other reasons people make changes to their companies? They want liquidity, they sell their company, they're burned out, they want to take another direction, health concerns, or you might be one of those small or large businesses in the room looking to acquire another small business. And another reason, and even though a large company, if they acquire another small business, they're like, well, what's that worth, right? Now, I've acquired a small business. I can't do business as a small business. I'm still a large company. But that small business might have key relationships. They might have past performance that you want to acquire for your own company. And that's why a lot of large businesses look to acquire graduated A-Days or companies that have a lot of good past performance. And some of these tips you might think about in terms of when you're talking to a prospective as a buyer or a seller, you know, these are conversation tips that you might want to have in terms of, wow, why would I want to, you know, if I was a small business and I had a lot of past performance, that's how way I would approach a large business who wants to buy, is looking to buy. I'd say, I've got the past performance. I've got the relations with USACE. I can do that. I could bring those people to the table. And that's very attractive for a large business, especially that wants to grow in their federal practice, practicing. So for most small businesses, selling your business, that's a lifetime, once in a lifetime. It normally doesn't happen numerous times. Normally, you as small businesses, most of you are engineers, architects, and contractors. You're focused on your core business. You're focused on the work. You're focused on building codes, right? You're not focused on, you know, how to ready your business for sale. Or infusion of capital, or any other reorganization of your business. So most owners fail, I find, who come to me to consider and address many key issues before these changes are made. And that's really not good. And I'm going to give you a few examples. Big picture, a partial ownership change will trigger a potential loss of your certification. So here's an example. A client of mine, an older gentleman looking to retire ultimately. He is a service-disabled veteran, and I helped him get a CVE certification. And he's looking to retire. His son is also a service-disabled veteran, and he's got buddies that are. And so slowly, the son and the two other buddies started buying ownership interests from the father, right? Helped him with retirement, et cetera. Well, the VA, you know, they said, Michelle, it's going to be a simple no-brainer, the VA. We're all veterans, right? not so much. The VA asks a lot of questions because they want to make sure who's in control of the company, they want to make sure it's legitimate, et cetera, et cetera. So, you know, they faced a potential loss of certification, but because their paperwork was in order, the VA approved them, and they had a continued, because you want continuity in your certification. You don't want to lose the certification and then have to reapply, because you know, especially those of you who are veterans, what a headache that may have been. Planning, must plan in advance. A company came to me saying it's a fuel business, they have to sell now. Why? Union problems. But they didn't plan in advance and they closed down. So that's just an example of people that really, you know, when they want, and it happens a lot when it's a sole owner, and the sole owner doesn't necessarily have family members working in the business, and the sole owner faces health issues, they have, and they haven't planned to sell their company, and they have to just simply close it down. When you're planning, you need to include key stakeholders. You want to include your accountants, people that you're, you know, if it's family members, your family members, as well as knowledgeable attorneys or professionals that understand certifications and the process, because that's what you don't want to lose. It's so hard to get them, and you know the amount of money that could be, that you see having a hub zone certification or an 8A or any other certification. What is a partial change of ownership? Well, that happens when you want to add new shareholders, or if you're a limited liability company, new members or partners, eliminate and then there's an ownership change when you eliminate. So maybe one of your existing shareholders just wants to retire or get out. That's an ownership change. And then succession planning. That's normally the partial ownership changes. These are the situations. Complete ownership change, succession planning again, or an outright sale of the business. So we're going to talk a little bit about family succession planning, and I'm glad I just put this recent slide in for veterans. But what you want to consider, and how many of you have family members working in your business? Normally, it happens a lot, right? So let's say you're a woman-owned business, and you have a daughter, but she's a rocket scientist and she lives in another state, right? But you only have sons working in the business. How do you, you know, all of a sudden you want to do succession planning, and you want to give stock to your sons, gift it to your sons, sell it to your sons, but it's no longer going to be a woman-owned business. It might still be a small business, but not a woman-owned business. Or do you think about, I've got a daughter, she's right out of college, she's always liked being around my construction company, maybe I start teaching her about ownership. Maybe I make sure she gets in the right classes and she starts understanding estimating and scheduling and bidding work and how to schedule labor and schedule materials and things like that. So you've now planned that succession. So when it's time to start giving her stock, and by the way, if a woman owner is a single woman owner and she dies, there is no WBE, there is no WOSB, and nobody owns the stock. That goes into a estate. Okay, so it's not a woman-owned company anymore. But if a daughter owned 1% of that company, then she becomes the 100% owner, and at least you've got continuity in ownership. All right. So, and then what happens when you want to transfer to your sons or your daughters? You own the company, but you've got sons or daughters that aren't in the company, and how do you fairly compensate them? It's like, wait a second. You're giving stock to this is a $35 million company. You're giving all the stock to my brothers or my sisters, and what about me? So you've got to think about other ways to compensate your children to make sure that there's no arguments over the Thanksgiving tables. And then you have to think always about certifications, and I'm going to give you a bunch of examples about that, because if you, in one scenario, if a stock is gifted, it might be okay. But if it's a DBE, it's not okay. You could lose your certification. Or the new person cannot be certified because the stock was gifted to them. So it's really important, and what I do when people want to make ownership changes, the first thing I ask them is, what certifications do you have right now, and which do you care about retaining in the future? Ownership, and here's an example of ownership. So a woman came to me and I said, and this was for a city state agency, and I said, how did you get the stock? And she said, it was an inheritance from my dad. And then I said, well, isn't your dad still alive? She said, yeah. I said, it's not an inheritance, all right? But they had put that on the application, and I said, that's a problem, because you wrote an affirmative, when you apply to an agency, whether it's the VA, whether it's the SBA, whether it's the state of Wyoming, it doesn't matter. That's an affirmative representation, and that can turn into a false statement, right? So, and let's talk about the gift situation. So under DBE example, they mandate that for purposes of determining ownership, we presume is not being held by a DBE, a disadvantaged individual, interest in a business obtained as a result of a gift or transfer without adequate consideration. So that's why I say if you're also DBE, you've got to worry about that in terms of continuity of all your certifications. I think I might walk down to the ground in a minute, make sure I don't step off the stage. But, and then I want to talk about this new final rule from the SBA. And this is a very cool rule, is a continuity of certifications. So it's effective October 1st. And what the rule says is if your surviving spouse, whether you're a female veteran or a male veteran, can actually continue to qualify as your firm as an SDVOSB for up to 10 years, all right? That's huge. That's really huge. And the reason they do it is to make sure that the family is taken care of and, et cetera. So there are requirements. The deceased veteran spouse acquires the ownership, so there must be an ownership transfer. The veteran has 100% service-connected disability rating or died as a result of a service-connected disability, and the firm was listed in VetBiz. The timeline that it starts, the date on this timeline it ends, if the spouse remarries, they lose the SDVOSB status, the date surviving spouse relinquishes ownership, or 10 years after. Now, what's really interesting in this is control. Well, I want to talk about another interesting, so for those of you who are veterans and talk to your senators and things like that, some veterans aren't married and they're severely disabled, right? And they might have a family member. They might have a child or a mother or a father that they're not married, right? They're family members, but they are caretaking and they're helping with the business. And there's no rule for them to continue ownership. And I think that's sad because it mandates that there's a spouse involved. So maybe you're a veteran and you have to be married for 30 years, but you got divorced. But you have sons and daughters in your company and you want that continuity. So that's my issue with that new rule. My other issue with the new rule a little bit is about control. It doesn't say let's say it's a service disabled veteran, a male, and there's a female involved, but she might be the vice president of Microsoft, right? She's not even running the company. So they don't talk about control whatsoever in terms of the spouse taking over the company. Moving on, partial changes in ownership. Better. Now I can make sure I don't fall off the stage. So here were the scenarios: employees, other shareholders, new investors. So stock options. How many of you have considered giving your employees stock options who are veteran-owned firms? Some of you, okay? Or MBEs, WBEs, et cetera. The rule is if you only have 51% ownership and you give away even 1% or 2% stock options, the SBA, along with other agencies, deemed those stocks exercised, meaning that if you give away 2% and you're 51%, even if it's a stock option, in their minds the option's been exercised and you only owe 48% of your firm. So be very careful with stock options if you have certifications and you want that continuity of the certification. A lot of people, what they'll do is they'll issue phantom stock, right? Companies, because it's not stock at all. It's basically, it incentivizes employees to stay on, And it basically, a lot of people do it, and it could be structured all different ways, and I don't know why they call it stock, because it's not stock, but they do use the word phantom. But normally what happens is that, let's say I have a really great business, but I want to grow it, and I've got key employees, and let's say one key employee that I know is going to help me grow that business. Well, I'll issue them phantom stock, which means, and in the agreement, this phantom stock agreement, what I will do is I will say, upon the sale of the company, I will then share certain profits with you upon the sale. And that incentivizes them to help you drive business, right, to grow that business. So that's a way that you can stay away from stock options. What if the employee can't pay the market value of the ownership? You know, can you personally loan the employee money? Well, it would really depend. It depends on what certifications they have, and it will also depend if you're going to remain an owner of the firm and remain with the firm. There's a lot of things that you need to take into consideration. Loans, we're going to talk about loans in the last few slides. Does the transfer compromise the required 51% ownership? Now, HUBZone, they don't care who's controlling the company. They don't care that it's a veteran, right? But it needs to be 51% owned by U.S. citizens, you know, unless it's a tribally owned HUBZone, right? So if you transfer stock to somebody who's not a U.S. citizen, that could be problematic for HUBZone certification. And then a death of a shareholder normally will destroy the certification altogether unless there's continuity. Let's say there was 3 women owning a WOSB, 1 woman dies, it's still 100% owned by women, for example. Now, what happens if the other shareholder was a former 8A participant? There's special laws, special rules that the SBA has. I think I've got some slides on it, and if we don't see them in the next couple, I'll explain it. Can other shareholders pay market value of the stock? So whether you're selling your company to your employees or you're actually relinquishing your stock to the other shareholders, can they actually afford it? And what is you might have had a shareholder agreement in place for the last 20 years, but it's really outdated, right? And if your shareholder agreement restricts you from selling to outside third parties, let alone, selling to other shareholders versus redeeming it and giving, basically that means giving the stock back to the company and getting money from the company, that might be all within your own bylaws or shareholder agreement, and that needs to be changed or modified so you could actually do the transaction that you're contemplating. Sir?
Let's say, for instance, your government stock was priced at $1 a share when you started the company, and you issued 1,000 shares, and you decided to go ahead and you want to zero out or transfer ownership to somebody else, and ultimately you decide to say, okay, here's for whatever it was, let's say it was 10 years ago, your company is worth a lot more today. Are you still allowed to go ahead and use that original valuation?
No, probably not. The IRS wouldn't allow it either. So, no, because there's tax consequences in a sale. So, but that was a good question. If I bought my stock 15 years ago at $1, can I sell my stock today for $1? That's, and now the company's worth $10 million. And the answer would be, yeah, you would definitely. Well, they're called valuations, but you're very close. And you don't necessarily need to get a formal, and we're going to talk about valuations, you don't need to get a formal valuation, but I would definitely speak with your accountant about it and talk about the ways, and we're going to talk about some ways that companies value their company, because formal valuations can actually cost a lot of money. Moving on. Is it better if I'm up there or downstairs? Upstairs or downstairs, everybody? Partial ownership changes to other company. So maybe another company wants to invest in your firm. Is that allowable under your small business designations, right? Will that be, so it's like, so what? It's just, they're a small company, I'm a small company. It could be done. They could invest in you. But is it allowable? And that's what you have to look at. You go back to the eligibility of the veteran eligibility, for instance, and say, what is the definition of a veteran-owned firm? And does it include other companies, et cetera? And will it create an affiliation to the point that we've increased our size caps and now we're no longer a small business? And then, which I'm going to give you an example, well, this is an example, it's a mentor-protege example, but, you know, if, let's say a mentor wants to buy a protege, right? And they can invest for up to 40% equity interest in the firm, and I have a slide on that. But the protege is an S Corp, and the mentor is an S Corp. Is there a problem with that? Yeah, that's a big problem, because only people can own S Corps and not other companies, all right? And I've had mentors and proteges come to me saying, you know, that I'd never met before, and saying, we blew it. You know, they put together this whole deal, and they didn't realize that they could never own that company, okay? So we had to convert the small business into an LLC, so an LLC can be owned by another, for instance, S Corp. So those are the examples that you have to want to think about as you are selling a portion of your company or buying a portion of another company or an outright sale. So, you know, the new mentor-protege rules are awesome. Says not, and so the rules say, notwithstanding the requirements of in order to raise capital for the protege, the mentor can own an equity interest of up to 40% of the protege firm. That's awesome, especially for large businesses that are investing a lot of time and money, putting up the bonding, for instance. That's awesome. But I want you to think about this, and that is the morning after. What happens when that same protege is also a DBE or an MBE, and now another firm owns them in the same line of business, right? Because more mentors or proteges are in the same line of business. I did this presentation in Nevada, and the people from the DBE program were there, and I said, they'll lose their DBE. And the head of the DBE program stood up and said, that's right, they will lose their DBE, because we don't care about the SBA program. It's our rules for DBE. So you got to be careful. And remember, that mentor-protege is a 3-year term or a 6-year term. What happens after that 6 years? That protege now wants to bid on a a small business veteran set-aside. Can they bid on it? No, because they're now affiliated, and the SBA is silent on that. After the morning after that mentor-protege term, they're going to be affiliated after that term expires. So all of you who are thinking about mentor-protege, think about that, you know. So current 8A owner looking to retire but has 5 years left on their 8A. He sells 49% of his firm with the approval, well, we don't know about that, to another minority, all right? And what he did is he said, I'm going to let you purchase the remaining 51% after a certain term. I just threw out 3 years. So, but that 49% owner was a prior 8A owner, okay, 15 years ago. It was a failed 8A, but 15 years ago. Is that okay? The answer is no. The SBA will not allow it, because that 49% owner will be the continuity of ownership, and because he owned another prior 8A, you only get one chance to be 8A, unless you're tribal, right? So everybody should be teaming with the tribes, and there's a couple great ones here in the room. So equity investments, new owners, considerations and red flags. So let's say somebody wants to invest in your company, right? It's highly scrutinized. Your certification is going to be scrutinized by other agencies. So they're going to ask, well, what other, you know, oh, you're both in dredging? You're both doing dredging? That's a problem. And why do they sense it as a problem? Why do the agencies don't like when a large business is buying into a small veteran business or 8A business? Because they set aside these contracts for the small businesses. They're not setting them aside for the large businesses, so they want the small businesses doing the work and having the contracts. A lot of times investors in your company, new people, even if they're passive investors, meaning they're not active with the company, they're just stockholders, but some of them want to be more active, and they want voting rights. They want to be on your board of directors. Well, remember, as a veteran-owned firm, an 8A, a woman-owned firm, you have to control the board of directors, or you have to control your firm. You have to control your firm, both legal control and operational control. And so if your new investors have the ability to oust you as a director, you lose your certification. Done deal, right? So you've got to be careful. You've got to work all this out. And when I'll talk to other companies, and they come to me, Michelle, I want to buy a piece of this company. I said, well, let's talk about what you can and cannot do. Just know you can own a piece of this company, but you surely can't be on their board of directors. You could be a passive investor. It'd be much better if your investor, let's say you're a veteran-owned construction company, your investor was a dentist in Nevada, right? He has nothing to do. He's a passive investor. But when there are people in the same or similar line of business, that's highly scrutinized. I've had situations where the companies have offered stock, so they have 1,000 shares issued, right? And 1,000 shares authorized. That's all. It was authorized. 1,000 issued, 1,000 authorized, and they don't know it because somebody did it for them 20 years ago, and now they're selling stock, and now they're having the company issue more stock. The company can't legally issue any more stock. You've got to have the company authorize more stock, and then it could be issued. And then sometimes investors, what they do is they want to convert that loan. They make loans to companies, and what they'll do, and hey, it's legitimate in terms of their business interests. They should be able to do this. They want to ultimately convert those loans into stock, right, into equity. And what happens to your certification if that takes place, or when the agencies find out about it? Are they going to say no because we consider that an option, and they've just exercised? We deem that option exercised. Is this helpful? Yes. Any questions? No. Okay. So selling a portion of your company, issues to consider and address, control. And then we talked about that control part. They want to be on the board of directors. They want to be, you could be the CEO, I'll be the president. It's like, I don't think so. So I'm a woman-owned company. You're a guy. Can't do that, right? And then are there negative control contained in key documents? And what do I mean by that? Maybe the operating agreement says that even though you're the manager, you don't have the ability to transfer your stock, okay? You always have to have the ability to transfer your stock in life or in death. And I'm going to talk about control ahead of time. I always see two types of control. There's legal control, that's what's in the corporate documents, right? And then there's operational control. So those of you who get 8A certification, as you know, if you are a structural steel company and that's what you've been doing for 15 years, and you buy a law firm, you're not going to be able to get yourself certified as a law firm because you don't know anything about the law, right? They certify you in your expertise, and that's what we call operational control. Do you truly run this company? Or are you what they call rent-a-vet or a suitcase contractor, or all those things that we hear about in Department of Justice indictments? Certification, huge part of the equation. So we talked about ownership control. And so the big question most people have is, how do I transfer or sell partial full ownership and keep my business a veteran-owned business or a woman-owned business? So payment for new ownership interest, it really varies on the agencies. Some people, for instance, gifts are fine. Other agencies, gifts are not fine. For DBE, a lot of WBE, MBE certifications, they ask the question in the regs, they say, was the payment real and commensurate with ownership? And I'm going to give you examples very shortly. We talked about, be careful what other certifications does this company have. And then ownership transfers between husband and wife under the highest amount of scrutiny, okay? And WOSB right now is still a self-cert, even though Congress said it shall not be self-cert anymore, but the SBA I'm hoping the SBA will issue new regs very soon about that. So if you're looking to potentially mentor a woman-owned small business, or you're looking to buy a woman-owned small business, I would ask, do they have any other certifications? Have they been vetted? Because WOSB is a self-cert, and people go online and they don't know the rules for ownership and control, and they may not legitimately be a WOSB, but they're saying they are because they're self-certifying. If the new owner is at least 51% woman veteran, they must also control the company. We talked about legal control and operational control. So questions I get, my wife, can I simply gift my shares to my wife to make it a WSB? What's the answer, everybody? No. This is good for bid protests, too. There's a veteran spouse to convert the firm to a VO, I'm sorry, let's move on because that goes to the WSB. It's also the same for veteran. My spouse that's a minority, I want to convert my business from a family-owned business to a minority-owned business. Can I just simply convert from a family-owned to a minority-owned or a woman-owned? It depends. Does she truly own and control that company? So let's see an example. There was a case in 2017 called Yardmasters. It was a protest. And what happened is there was a family-owned business that was converted to a woman-owned business to bid on a WSB set-aside. And these are some of the facts from the case. It's a protest. So what happened is that they made last-minute changes to qualify as a WSB for a U.S. Army mission and installation contracting command for grounds maintenance in Utah. The husband and wife each owned 50% of that company for 17 years. In defending the protest, YMI, that's the name of the company, they told the SBA that after attending a site visit for a WSB set-aside, it would be advantageous to have Bryce sell 1% of his stock to Sally, and she could be the CEO, and we become a WSB. Sally stated, when asked by the SBA, that she acquired the additional 1% it should have been sold. Acquired the additional 1% ownership from Bryce shortly before she submitted the bid. Sally stated, I made Bryce the COO. What's COO? Chief Operating Officer. And those of you who have gone through certifications, what does the 8A ask? What does DBE ask? What is veteran? Who's operating the company? She made her husband the Chief Operating Officer, where he oversees the operations and is the president. So moving on, the SBA said, how did you get the stock? And he says, well, she paid me $100 cash of her personal money. How do you want me to show that? Well, the SBA held that there was sufficient evidence that she paid for her stock, that she paid that $100, right? But the corporate documents was contrary to what they said. And so what happened is that in the corporate documents, it says Bryce Wade, not Sally, holds the highest officer position. He's the one who's managing the concern's daily operations. So accordingly, I conclude that they did not err in finding that they were not controlled by a woman and therefore not a WSB. So that's an example of what the things I've been telling you. Now, but let's look at the DBE regulations. What do they say about, and we apply it to that scenario. What rule governs ownership? Insufficient contributions include a promise to contribute capital, an unsecured note, and then look at the red, or capitalization not commensurate with the value of the firm. And then they go on to say, here's an example. This is the U.S. Department of Transportation DBE regulations. They say an individual pays $100 to acquire a majority interest in a firm worth $1 million. That is not substantial and real capital. So, and the DBE regulations are very specific about that. You know, this is right in their regulation, the example. They also say, DBE, you must presume as not being held, let's say in this scenario, by a woman, for purposes of ownership, any transfer without adequate consideration. To overcome the presumption, there's a presumption that it's not real ownership, it must be demonstrated by clear and convincing evidence that that gift and transfer to the disadvantaged individual was made for reasons other than obtaining certification. Now you go back to the SBA example, they admitted to the SBA, I gave her 1% of my stock to become a WSB. The DBE regulations wouldn't allow that. What rules govern determinations of control? If you cannot determine that the socially and economically disadvantaged owners are distinct from the family as a whole, then it's not a DBE firm. So they have very clear rules, and unfortunately on the SBA, the WSB rules are not as succinct as these rules. So Here's a veteran example. 2 people in a business located in Kansas City, Missouri were charged on an 8-count indictment due to an alleged conspiracy to defraud the government by falsely representing Patriot Company as an SDVOSB or veteran business in order to fraudulently obtain government contracts. The indictment alleges that Patriot was a pass-through or a front company for a construction company owned by Wilson during the scheme. Conspirators allegedly used, I can't pronounce his name or see it, this dude's veteran and SDVOSB status in a, quote, rent-event scheme to bid on at least 20 government contracts and receive $13.8 million, to which Patriot Company would not have otherwise been entitled except for the SDVOSB status. So what happened there? Well, according to the indictment, the dude, a service-disabled veteran, worked full-time employee for the Department of Defense, and he had a veteran-owned firm. Must have self-certified that one. And did not work full-time for Patriot. The dude did not actively control the daily management, daily operations, or long-term decision-making of the company. The dude never managed a construction company prior to his involvement with this company, and he had limited government contracting experience. The indictment cites an email exchange in which Wilson, the conspirator, discusses leasing an office for Patriot and says, I would like for you to get a thing or two from Paul Salvages to put in that office that is personal. Anything from his military, any plaques, U.S. Army stuff, or anything that if anyone stepped in, it would look and feel like he was there. Not good. The indictment also refers to a series of emails in which the dude was still contemplating the start date, which he would start owning and controlling his company, or running his company. So that's an example. I do this presentation it's called Government Climate, and I've got like, I don't know how many, 20, 30 different examples of these types of things. And they're, sometimes these come about because of protests, whistleblower actions, or people just calling the Inspector General and say, on their competitors and said, I had enough. This is not a legitimately, company. Very important, if there's any change of ownership, especially veteran, 8A, any change of ownership, HUBZone, you have to notify the SBA or the VA, because any change in ownership could potentially decertify you, and if you don't timely notify them, you could lose your certification. Now, the 8A has a very, very special rule, and they say you can't seek forgiveness, you must ask permission. So even, let's say you transfer your firm, you're a veteran firm, and you transfer to your brother who's also a veteran, right? Should be fine. You're both service-disabled veterans, should be fine. Well, then you let the VA know about it through VetBiz, and they'll look at your paperwork and approve you more likely than not. But if you're 8A certified and you make that type of change, you will immediately be decertified. The SBA says we need to know about any contemplated ownership changes in advance, and we have to grant permission. Otherwise, you will lose your certification. And I'll get you just 1 second. Here's an extreme example. So this is from the SBA's regs. A firm can be terminated from the program by not gaining our approval before any ownership change is made. So what happened is this firm, apparently they got advice, good advice from an accountant that says, let's convert from a corp to an LLC, right? That's legitimate. Same owner, same company, nothing has changed. They simply converted their tax status, right? The SBA immediately terminated them because the SBA says it's no coincidence that we didn't actively intend to violate the regulation. Any change of ownership could be grounds for termination. Acquiring new business. So we talked about, certifications, and now let's talk about types of acquisitions. There's something called a stock sale. That's a sale of 100% of the ownership of the company. The company remains the same. So for instance, in a stock sale, let's say you have a federal contract and you own 100% of the company, and somebody else buys 100% of that stock. You will maintain continuity with the federal government. You don't have to do what they call a novation, right? Because it's still the same ownership, right? But when there's just an acquisition of assets, or you want to sell a contract to another person, because you could sell your government contracts, right? And a lot of people do that. It's a moneymaker, right? And why do they do that? They do it for past performance. So for instance, long-term IDIQ, you know the guy who's had the long-term IDIQ, it's the 5th year, going into the 4th year, 5th year, and you want to buy that contract. And why are you buying the contract? Let's say it's with the GSA. So when it goes up for rebid, you've got the past performance and you're the incumbent. And that's worth a lot of money to a lot of people. And then asset sales, and like this slide, this slide is on the website. So selling to third parties, outsiders. Historically, no readily available market. It's very hard for small businesses to sell to outsiders, right? Unless they're selling directly to their competitors. It's difficult because your relationships are, you know, because you've got the relationships, they don't have those relationships. And a lot of women, other women, minorities, and veterans just simply don't have the ability to pay, especially if you've turned your company into a $20 million company. Tips to locate buyers. How do I find a buyer, right? I want to sell a portion. So lots of people out there, okay? Oops, the slide didn't have it. So I'll tell you, go to your lawyers. Your lawyers know who are buying and selling companies. Bankers know who wants to buy and sell companies. Your accountants know who are, because it's their clientele. I don't know how many people have come to me saying, I want to buy or sell a company, and I was like, I don't know, I have a client that was looking to buy a company, right? Or I have a client looking to sell a company. So you go internally, right? You can use investment banking firms or brokers, and they cost a lot of money, but hopefully they're very good, and they're going to point you to the right company and vet the right company for you. But looking in-house, or, you know, a lot of people look first to their family members and then their employees. Sale price considerations. I don't know why that didn't come up, but, can stock be gifted? It depends. We talked about that. What is market value? Market value is a variety of scenarios. There's something called EBITDA, and that's very technical. I'm not going to go into it right now, but I'll give you a formula a lot of people use. And can you help them afford it? A lot of times you can help them afford it, meaning, you know, they put down money and you take on a promissory note, okay? But if it's a bank loan, so here's a typical example. A woman wants to buy the business from her father, and the business is worth $20 million. And the father says, okay, well, you give me a $50,000, and I'm going to loan you the rest of the money. Because he's still in the same line of business, right? And he hasn't retired yet, and so it's basically converting a male-owned firm into a WSB against most of the rules. So what about, you know, you're looking to sell either to an investor, you're granting ownership interest in your company, maybe you're 100% owner and you want to give 20% to somebody else. So what do investors look for? They look at your financials. They want to know your history of profits and losses. And you have to ask yourself, what makes my business attractive? You know, what are the real selling points in my business? Going to conferences like this and walking up to trade booths and people talking about their businesses, it actually helps you to think, yeah, I do that, or I have that to offer about my business. Why don't I talk more about my business that way, right? Here's a winning formula that a lot of lawyers use and accountants use, a combination of retained earnings, positive cash flow, low debt, ongoing contracts, lucrative ones, good customer relationships, and collectible accounts receivable. And then what are the sources of revenue? So here we go. You are a veteran-owned company, and you want to buy a veteran-owned company, and you're a veteran. You have no company right now. And that veteran-owned company has getting all their business from a really, really big general contractor, right? They're like 90% of their income is coming from this general contractor. I mean, they're doing municipal contracts together. They are hooked, you know, they're together, right? Well, the SBA says that that's an affiliation. If a company gets over 70% of their receipts, gross receipts, from another company, not from the federal government, but from another company, they're unduly reliant upon that other company, and therefore they're an affiliation, and we're going to add their gross receipts together and no longer deem you a small business. Okay? And that's a fairly new rule that came out the SBA had a lot of decisions on it, and it actually came out as a formal rule in 2016. Sir? Correct, correct. They do have an exception to that affiliation, and they say, you know, we know as women, minority, and veterans, sometimes we don't get a chance from anybody. Only one company is willing to give us a chance. So for the first 2 years, if my only source of revenue or my primary source of revenue is from one company, they get that, and they say that's okay. But year after year after year, no way, you're affiliated. Valuation methods. Normally it's assets such as cash, receivables, inventory, equipment, and real estate. There are various formulas, but you need to just seek guidance from your accountant or your lawyers about it. So, getting ready to sell. Resolve any unpaid accounts receivable, prepare projected financial statements. Do you have a business plan in the future that you would give to a prospective buyer? Secure relationships with your existing suppliers. Let them know about if there is this ownership change, will they continue doing business? Let them know your key employees are still going to be there. The key players, everything you need everything your customers need is still in place, even if you exit the company. Can licenses be transferred? A lot of times licenses simply cannot be transferred. If the company's got a license, let's say the company, an engineering license, right? So there's 3 engineers, they want to exit their company, and 2 more engineers come in, and they want to buy the company. Are these licenses transferable in terms of being a professional engineering firm? No. You've got to seek permission, once again, from your Department of Professional Regulation. And then what is the status of your office lease? Is it a 40-year lease in a location that's unattractive and nobody wants to buy it, nobody wants to take over that lease? What's your physical space look like if they're going to take over your physical space? Do you have any warranty issues on your contracts that are pending? Resolve any lawsuits, so you don't want to have to discuss lawsuits with the other guy. Any current contracts that are going sour? Do you have any outstanding employee issues? Are you union? How many of you are union? Okay, so there's a few of you. You have to worry about something called unfunded liability, which is a whole different section, but that's a big deal when you're selling your company. Do you have any regulatory violations or any OSHA violations that need to be corrected immediately? Federal contracting considerations, when there is the FAR 52-219-28 requires a firm to recertify the status within 30 days of a stock purchase or a merger. So just know that in talking to your attorneys, if you're going to do this, that you're going to have to notify, you're going to have to recertify under your reps and certs. Special due diligence, what types of documents should be reviewed? So you want to, if you're buying another company with federal contracts, you want to make sure certain things are in place. Especially you want to make sure that they've been compliant, all right? And you're not going to be stuck with their bad stuff. Procurement integrity, was there any, when they bid on recent contracts that, was there any procurement integrity breached? What pending bid proposals do they have, right? That could be awarded any day or in the next year. What are the warranties? Are you having to give out 20-year roof warranties when the roofing manufacturer only gives a 5-year roof warranty? Investigations, are there any pending investigations against your firm by the Department of Labor or anything like that? Are there any threatened?
We're right at 4:30.
Oh.
Do you have a few more?
I only have a few more.
We can go a little bit longer if that's.
Do you want me to
that's
go?
okay
I only have a
with
few more
folks.
slides.
Okay.
If there's any
Okay,
pending
we'll keep going.
T for Ds.
We're just going to have limited
Okay.
time for questions.
So you want to ask them proof of compliance, EEO compliance, cybersecurity. That's the new regulation now. When you're bidding, you have to be compliant, NIST compliant. Do they have a business ethics program in place? Do they train their employees in business ethics? Have they complying with Buy America? Any restrictions on the ability to transfer ownership? We talked about that. And then I just want to go into financing in the last slides because I'll take any questions. There's something called an earnout, And an earnout really is, let's say you're buying a company, but you either can't afford or don't want to afford the full purchase price because you believe that, you know, it sounds too good. You know, our profits are going to go up to $10 million next year. And you say, yeah, I don't think, you know, we'll see. So an earnout is you're paying a portion of the purchase price. You might put the rest of the money up in escrow, and then, I'm sorry, that's a holdback. You put a certain amount of money up in escrow, and if the company does see those type of earnings, then it will be paid out, right, to the prior owner. An earnout is basically meaning that the company actually pays the remaining purchase price through its profits over time. Now let's talk about there's debt, what types of financing are out there. There's loans provided by banks or institutions. There's seller financing where you're the seller and you're actually allowing the buyer to defer a portion of the purchase price. SBA-backed loans, which is incredible stuff they have. And then think about what they call key man insurance. Key man insurance is basically what happens is that allows, so for instance, let's say there's two veterans and own a company and one veteran passes, that stock would go to the wife. You can't be a veteran-owned firm, but if that gives the wife, basically it's a life insurance policy that pays for the stock so it could be redeemed by the company, so you're still the remaining 100% owner. Equity investment companies. These companies are about 350 companies that are licensed by the SBA, and they're investment companies, right? And all they do is invest in small businesses. Sometimes they take stocks, sometimes they just do loans. But the cool thing about it is that they don't deem you affiliated with that company. So that's why SBA investment companies are very, very important to consider. So the rule on SBICs, small business investment companies, there's no affiliation if the business is partially owned by an investment company that is licensed by the SBA. That's some cool stuff. So I know some firms that have their investors are SBICs, and who also invest in numerous other companies, and there's no affiliation. SBA loan. So let's say you want to sell to your other shareholder, right, the other stockholder, or a new shareholder wants to come in. The SBA will finance that. They help you finance that. So they give these loans for existing shareholders want to purchase the other shareholder's interest and resulting in 100% interest. It finances the redemption of the shares by interest by a shareholder, or it allows a small business that wants to purchase 100% ownership in another small business. But they say that the seller cannot remain an officer, director, or shareholder or key employee of the business. They will allow consulting agreements, but for only a short time. Any questions?
That's right. I've got one, and it's actually we're going through succession planning right now. I currently own 25% of the business. It is a service-disabled business at this time and was previously an 8A. So once the succession and I become the controlling, would I be able to take the business back to an 8A because it was?
No.
Before? So that would not. Now, would it be advantagesome though, because I didn't, I'm going to talk to the attorney about the law, you know, the veteran with the wife holding and keeping it as she would still have to legally hold 51% of the business, I understand that, but we would hold our certification for up to 10 years.
If you're 100% disabled, that's the problem.
You
have to have 100% disability.
Okay, not just service disabled.
Right, a lot of veterans are mad about that. 100% disability, that's a lot of disability.
Okay, so if I was to take it over there, I would be better off to basically dissolve the business, restart it, and to get back to an 8A status then.
Potentially, yeah, and if you want to talk afterwards, I could talk to you afterwards. And I have a booth at 1322, and I want to introduce my associate, Will.
wanted to emphasize that Michelle has offered, she's got a booth downstairs, 1322.
Come ask any legal questions you want.
For the next couple hours, you can do that. She'll be down there, but we will take, I saw there was a hand, we'll do one question, and then we'll close it out.
Okay, you know, obviously timing is important, but if you're going to, for instance, sell to a son, and all of this stuff happens, you know, you've got proposals out, you've got projects out, you may be in a third year of a 5-year MATOC. How do you get that you just say, all right, a year in advance or something like that, you specify the date, so you go ahead and get everything set up and get everything to pull the trigger on it? Or can you just do that and then follow through eventually?
I would start, if it's a family member, I would start that succession now. So it doesn't, maybe you're 100% owner, maybe you have, you said a son, maybe start giving him 2% ownership, whether he's paying for it, gifting it. You know, you need to talk to knowledgeable professionals, because you don't want, if he's a veteran too, and you ultimately want to make him a veteran firm, you don't want the VA saying he didn't pay for his stock while you were alive, as opposed to gifting it after death. But, you know, to remain the continuity of ownership, I would start it right now, you know, and I wouldn't, you know, you don't want to buy, okay, 2%, 2%, 2%, all the way up to 49%. That's a lot of changes, and you have to notify the VA every single time. So, you know, I would do it more in chunks of, you know, maybe 10% or 20% at first, and then on. I'm going to stay here for a while if you want to stay after, but thank you all for your time. I really enjoyed it.
How about a big round of applause?
Thank you. I really appreciate that. Thank you.
May not get a chance to get down to your booth.
I own 94% of my corporation. I'm a service disabled veteran. Now, Trump's changed the tax law. And so the bank has come to me and told me, you know, with the estate attorney, that I need to give my wife some of the stock because he's changed the 11 million
The gift.
to each. So now you can.
Oh, is that right? You know that?
Stock in her name. We get 22 million.
I'm sorry, what?
You know what? Come by my booth, give me your card, and then, because I work hand in hand with my estate planning lawyers too, and then and they know all about this, and they can, you know, we can help you with that, because you want to do it the right way.
You understand what I'm saying? So,
Yeah, I know. I just have to just allow people in line, and your question is more detailed. That's why. So say, you know, but you just have to remember, as long as you're 51% owned, you're going to be fine, right?
I own the 51%.
And